What is a business development company? A business development company, BDC, is a closed-end investment company designed to provide financing to small and mid-sized enterprises, as well as distressed firms. These companies often seek BDCs for funding, especially when they are unable to secure capital elsewhere. Additionally, BDCs assist struggling businesses in regaining economic stability. Typically, BDCs invest in early-stage businesses or those experiencing financial hardship, and they also provide managerial support to their portfolio companies. BDCs are appealing to investors who seek high dividend yields or an alternative investment to exchange-traded funds, ETFs, and mutual funds. While BDCs offer significant benefits, they may not suit every investor. Like any investment, understanding how BDCs operate and whether they align with an investor's risk tolerance and goals is crucial. Many BDCs are publicly traded on major exchanges like NASDAQ and the American Stock Exchange, AMEX, offering relatively easy access for investors. Though these investments carry risks, they are known for providing substantial dividend returns. BDCs allow non-accredited investors to access investments in private enterprises and select companies, a space typically difficult to enter. BDCs aim to generate capital gains and income, similar to private equity funds and venture capital. One distinguishing feature of BDCs is that they must distribute at least 90% of their income to shareholders, offering high dividend yields. Additionally, investors can purchase BDC stocks on the open market, participating in ventures that were previously limited to private equity or venture capital funds. BDCs are strategic in selecting firms for investment, typically targeting companies with the potential for significant growth. They may also offer consulting services or take board seats in these businesses to influence their direction, anticipating that the value of their investments will grow as the companies expand. In some cases, BDCs lend money to these businesses and charge fees for consulting services. To qualify for BDC financing, companies must meet specific criteria. They must be domestic corporations or have their domicile in the United States, and they need to be registered with the Securities and Exchange Commission, SEC. Additionally, BDCs focus on companies with a market value of less than $250 million. The economic impact of events like the COVID-19 pandemic can lead to portfolio companies defaulting on loans. BDCs also have relatively short track records, with most established only in the early 2000s, leaving investors with limited historical data. Additionally, BDCs are sensitive to interest rate changes, as rising rates can increase borrowing costs, reducing profitability and limiting their ability to make new investments.